Welcome to Commercial Real Estate Pro Network CREPN Radio. Thanks for joining us. My name is Jade Aaron Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is David Silliman. David is the CEO of Eazy, and he's here to speak with us about opportunity zones and opportunity zone funds. And in just a minute, we're going to speak with David about creating and utilizing an opportunity zone. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple of things you can do to help us out. You can like, share, and subscribe. And as always, we would love to hear from you. Please leave a comment. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. And you can find us on YouTube at Commercial Real Estate Pro Network. And also want to remind you there, if you would, please consider subscribing. Always love to see more, and it always helps attract more people as well. With that, I want to welcome my guest, David. Welcome to CREPN Radio.
Thank you for having me.
Well, I'm looking forward to our conversation today. And before we get into opportunity zones, if you could just take a minute and share a little bit about your background.
Sure. I got into the commercial real estate market. Basically, I came into a hotel deal back in May of 2018. And this was a month prior to the opportunity zone legislation coming out. And it was a commercial deal, like so many others, looking for money. And, got brought in to figure out where the holes were at in the ship, so to speak, and to make some corrections. And once I learned of the opportunity zone program, very quickly saw looked at the deal, realized that it was in an opportunity zone, made a pivot, launched it, the equity raise for it, launched it as a fund, and it ended up being the second opportunity fund in the country to ever open. And from there, it was kind of off to the races. Once we started building that up a little bit and getting out there, and then basically it was from there, went on to develop the first business-based opportunity zone fund, now since developed a little over $21 billion worth of project real estate related and business related opportunity zone funds. Count for approximately 1 out of every 8, 1 out of every 9 in the country. We've got our name, our fingerprint on it in some way, shape, or form, and have kind of been elevated up to really, one of the top 10 experts in the country on this subject matter on how to utilize this program the right way. We have a tendency to see things a little differently from a couple different lenses, and just, believe in this program. This is going to either be one of the biggest game-changing programs that this country has ever seen across all spectrums of both real estate and business, or it'll be one of the biggest tax giveaways in the history of our country. And I believe that it's going to be the first of the two. And commercial real estate makes up, right now, 85% of this market space. So this is a very, very hot topic, something still very, very new, very applicable. And, really with 2020 being the year of with extensions and everything else like that, this is a major year for capital gain investments, because that's what this program is basically built on, is capital gain investors investing into an opportunity fund that is built and developed around some sort of real estate or commercial development project that's there to support part of the equity stack, cap stack of that project. And it's designed for these cap gain investors to get in. And so you've got a mass tidal wave, given the amount of capital gains, the amount of liquidity that's in the market right now, getting ready to kind of all hit the proverbial opportunity zone shoreline between now and the end of the year. So this is a prime subject for the commercial real estate market.
Yeah, I would say, the stars are aligning, for what I know about opportunity zones, or what I've learned prior to this conversation. It's clearly looking for a way to stimulate investment in real estate and places that need investment. I mean, that was kind of the underlying thing there, and assuming you're able to turn a market with that investment, the value of that investment would be a significant increase there.
Absolutely.
Before we get running along, I didn't quite hear, what was your background before getting into real estate there?
I worked in tech consulting, doing capital raises. So I'd come into a company and, they'd want to raise a round A raise. So, I'd get involved and help them structure all the documentation and everything else like that needed to be done to adequately raise that.
Okay, so capital raising is not something that's, you're very familiar with that, so that would be, I would think, a
Yep.
head start for you versus somebody saying that's a great idea. Let's go with that. So let's back up just one step, and so we can all make certain that we're on the same page. Can you define what the opportunity zone is, or what an opportunity zone is?
Absolutely. So the opportunity zones are, number one, they're in all 50 states, Guam, Puerto Rico, and the U.S. Virgin Islands. So what they're literally designated census tracts where the economic numbers and poverty rates and stuff like that are within certain thresholds. And every mayor, every governor, so it was across all 50 states, submitted these census tracts saying, hey, we recognize these areas that are in need of economic stimulus. From there, it was approved by the Department of Treasury. So now, collectively, we've got, 9,000 plus opportunity zones. So for real estate purposes, it is literally comes down to an address being on one side of the street versus the other, being in a zone or not being in a zone. So you have a lot of these opportunity zones. And there's a misconception that, that the opportunity zones themselves are so, impoverished that, it really is not like an enticing investment for an investor to really want to kind of get into it. It's high risk, this, that. You have a lot of opportunity zones that are, poised for college growth, poised for, already doing, semi-decent or on the upswing, and investments are spurring that economic growth. So they're not all, bad. The program is a very special tax incentive program if utilized the right way. For investors, they get a bunch of specialized tax benefits by being willing to take their capital gains and putting it into what's called an opportunity zone fund. And the fund is then designed by structure and by terms, guidance from the IRS that it has to redeploy that investor's money into, some sort of opportunity zone project. The tax incentives, though, are what is the major benefit of the program. Kind of give you a really simple example. Let's say that I sold some real estate and I've got, a $500,000 capital gain. And for one reason or another, I wasn't able to, do a 1031 exchange, or I had a failed one, or I just wanted to get my principal back out. I got a $500,000 capital gain. So instead of paying taxes on it the way that I would normally have to, reporting it as taxable income for this tax year, the start of it is I roll my money into an opportunity fund. I now defer paying tax to tax year 2026. So I'm pushing that off for 6 years. The second thing is in that 6-year push off, I hit one of the anniversary hold dates in the opportunity fund, which is the 5-year anniversary. So what happens is as a capital gain investor, at the 5-year anniversary, I get a 10% step up in basis. So what that means is that on that $500,000, I'm paying tax on 90% of it, not the full $500,000 in 2026. But here's the amazing thing, which is why investors, are really beginning to take a look at this program in multitude of droves and outlets. It's the 10-year benefit. As an investor, if I keep my money into an opportunity zone fund for 10 years in one day, I get a full step up in basis to fair market value at time of exit. So let's say my $500,000 grew to $2 million. So I got $1.5 million gain. I have a $500,000 basis. I paid tax on 90% of the $500,000 basis. The other $1.5 million, I don't pay any tax on whatsoever at time of exit.
So that's on the subsequent gain that the no tax, right? The initial one, you still have
Still going to get
tax,
taxed, just
but
at a
it's
slightly reduced
reduced
rate.
based on your hold time,
Yep.
right? Yeah.
Yep.
No, I appreciate you kind of taking us through that, because I've had conversations with multiple people, and I would dare say that everybody understands what they are, or I mean, what you explained to me is the way I understand it, and I get it. The idea is that you have this gain. If you don't invest in an opportunity zone, you got to pay your tax. It's due.
Yep.
But if you choose to invest in this, we're going to give you, first of all, the time. You're going to get, what, 6 years to pay that
6 years
tax,
to pay the tax.
right?
Hmm.
You're going to get a reduction in the tax owed. So you've
Yep.
got the time value plus the discount. And then, like you said, the bonus of this is the hold
The
for 10
extended.
years.
Yep.
And is that 10 years from when you invest into the fund? Is that when the clock
Yeah.
starts? Or is it,
Yeah.
okay.
Yeah. Because the
Okay.
fund itself, reports every 6 months to the IRS. Couple things, number one, what the fund invested into. Number two, who invested into it. So yeah.
Well, and I think the other thing that you've touched on here that it took me a while to understand this, thinking primarily as real estate and looking at this as a real estate investment, the capital does not necessarily need to come from real estate. That was the challenge. It didn't resonate with me, is that not everybody coming into this, an opportunity fund, is necessarily coming from real estate. They could have sold Apple stock or Tesla or whatever it was that they.
Well, you're right. Let's look at what happened in March, right? We had a mass, sell-off in the stock market in March because of COVID. That sell-off generated almost $700 billion in new capital gain money. And that mindset is not real estate based mindset. That mindset is very, very much, I found stocks because I believe in the business. I see the product, I buy the product, good earnings, good boards, all that kind of stuff. When you go from that mindset as an investor, and now you've got capital gains, number one, up until now, the stock market investors really didn't take this program very seriously because they didn't have a need for it very much. I mean, they were just riding through the stock market. Now they do. You're taking a mindset that is almost primarily business and bringing it into a market space that's 85% real estate. And so, in the commercial side, where we see the biggest disconnect in is with the fund managers that are raising the money around the development, being able to adequately connect with the investors in the right mindset and getting both on the same playing field and educating why this is a good investment. And not just because of how your money's going to grow, not just because of what an IRR is, but most importantly, and almost always overlooked, is the exit strategy. With people that invest in stock markets, they know that the moment there's anything that begins to blip, man, I can trade, I can sell, I have an exit. With the opportunity zone market space, it's a very different animal because it's an extended period of time. And so, these projects are going to be relying on leverage in the future. And, but if they can adequately explain to investors today that, hey, this is what we're going to do this is the growth, the equity, this is how we're going to exit out, and we're going to either pay you back and you can choose to exit, or we're going to reinvest again into whatever the next project is. Because the 10-year time period is not project sensitive, meaning that the fund has to stay in a project for 10 years. It's just 10 years sensitive to me as an individual investor. So a fund can do, especially for commercial real estate developers, this is prime if they're doing, multiple deals per year and they're juggling, an opportunity fund could act as a real estate portfolio fund for them to support investments into all of their projects. But if the investors know the exit strategy, we find that they're a lot more inclined to want to pull the trigger. But yeah, mindset is a big thing. Big thing.
Yeah, because I think, again, just I think real estate people have a certain view, and even like with syndication and stuff, it took me a while to fully recognize that, because of the in and out, the speed of getting in and out at 1031 wasn't necessarily as much of a concern, because your depreciation is minimal. It's more about the
Right.
capital gain, which this totally plays to. So if you have been in a syndication that hit a home run, and you've got a big gain, and you're looking to park it or defer the tax,
Yeah.
and you like real estate, this seems to be a natural something to
Well,
to
you have a lot going on that when you look real estate at both today, tomorrow, and at time of various exit points, the investors are going to say, okay, if I put my money in today, who pays the tax in 2026, right? Am I going to have to just pull the money out of my bank account, which I would normally have to do anyway, but I would normally just pull it out of the capital gain, set it aside, and then use the capital gain differently, right? So if I don't have that ability, where does the money come from? And that's a big, big question when you talk real estate. And so what you've got to be able to look at is not just what the economics are on the deal today, but really what's going to drive the economics on the deal for exit tomorrow. We look at things like, okay, well, right now most commercial real estate loans, which are really how they're going to create the exit, is going to be leveraged. It's either going to be sold or it'll be refinanced out, right? So it'll be leveraged in some way, shape, or form. But what drives those loans? Well, if you're borrowing against it, most commercial deals are driven on the LIBOR rate today, but that's phasing out by the end of next year. It's a completely different, rating system that, commercial real estate rates are going to be based on. It's going to be based off the soft overnight offering rate. Well, when you look at that, that doesn't correlate to how the LIBOR moves with treasury rates relative to how the SOFR rate moves to the Fed funds rate. Fed funds rate is bottomed out right now. So we got to look at saying, okay, well, are we going to expect higher rates in the future? And just being able to really kind of put thought into articulating that today is what really makes these things, very viable, very attractive for investors to get into, understanding, because there's a massive amount of upside potential, especially when you look at like the riding and all the stuff that's going on across the country. Eventually, when it ceases, there's going to be a massive amount of projects and property that are going to be in these opportunity zones. The opportunity zones will be redesignated to include some of these areas, but they're going to pick properties up for pennies on the dollar and walk into a mass amount of equity with a low, flip time on it. And, so there's going to be huge, huge upsides for this.
No, and again, the 10-year hold, that was the thing that caught my attention, was the gain. And in 10 years time, especially if you're buying in an area that's needing investment, you've got time to turn that. And if you have a concentration of investment in that area, I would think that's kind of the recipe for a home run.
Yeah.
If you have enough investment going into an area that it can attract new business, new, just new activity, that's gonna. Because in Portland, Oregon, where I live, I can go to certain neighborhoods and show you what it was versus what it is, and
Yep.
the amount of time. 10 years is enough to fully or transform a neighborhood.
Yeah, and we're already seeing the seedlings of transformation in neighborhoods all across America with this program, believe it or not. Baltimore, Erie, the list goes on and on and on of different places where money has been invested. Projects are going on, jobs are being created, both in real estate short term for development purposes, but also for businesses in the area and in those areas. We're seeing very, very strong support from both state and localized municipality levels. State taxes where they're matching, the federal tax program. At the local level, we're seeing where localized community, municipalities are bringing in additional benefits, sales tax rebates, extensions on when taxes are due, discounted tax rates, all sorts of stuff to really try to take this and harness it, because it has that potential.
Right. So you've made the case for it's a good idea. How does or I guess knowing that like a zip code or I forget if was it zip codes primarily, or were there
They're literally census tract. It's address driven. It's not
census
necessarily
tracts.
like all of an entire zip code would be in an opportunity zone. They're kind of, believe it or not, if you're familiar with what the CDFI tracks are that they use at the Treasury level, they're a lot of them are just those plus extension areas from within those already predefined economic tracks.
Right. Right. No, and I guess where I was going with this is that, so we've identified the area that qualifies. Let's talk about the specific investment. You mentioned you started off with hotels. Um, if a fund has identified an area, a neighborhood, a tract, and what are the specifics of the property that make it qualify? Not that it's just located in. Can it be new
Okay, so
construction? Can it
it
be
does start off with the fact that number one, first and foremost, is the property in an opportunity zone?
right?
Okay. As far as the type of development, whether it's hotel, whether it's apartment complexes, multifamily, townhouses, single family resident, trailer parks, storage parks, you've seen, I mean, we've seen the gamut of them all. Okay. Doesn't matter. Starts with, is it in an opportunity zone? Number two is this something that is, number one, qualifying for A, original usage, or B, is it substantial improvement? Okay. The most of these projects, the idea is the substantial improvement piece, where the fund is going to come in, pick up, take an equity position, maybe even own it entirely and do the whole project as an opportunity fund, because there's nothing that prevents a fund from being a 1% equity stake in a project in the cap stack to the full cap stack. Okay. So the fund will come in and, it will have a couple things that it's got to do. It has to meet its basis plus $1 in substantial improvements. So, you've got that to take into consideration, but if done right, you still have huge upsides after improvements are done. Other than that, those are the two main things. It's not project type specific, it's applicable to all. There's believe it or not, there's 22 different federal programs, 2 executive orders that support this opportunity zone initiative. Everything from the USDA to the FHA to HUD to VA, you name it. All of them. This is a stackable program where new market tax credits, low income tax credits, historic tax credits, all of that stuff is all applicable within this program. So you really have a robust, and it was done and designed to, be private by design, to where you and I could get into great deals and invest. I believe that the mindset is, hey, let's spur investors to invest in their own backyard type thing. But it's designed to support any type of commercial deal.
You mentioned stackable. Can you spend a minute and clarify what you're
Sure.
saying?
Let's say that you've got a project that, let's say it's a housing development, right? You're coming into a low income housing area and you need some low income tax credits for building out a housing development, right? Well, you can use the Opportunity Zone Fund, and the Opportunity Zone Fund can take advantage of, when it does its taxes, those tax credits, even being a fund. So, when you look at the tax liability that then gets distributed out to either the members of the fund or the stockholders of the fund, because the funds are going to be designed one of two ways. Almost always virtually with real estate, there'll be partnerships. So that's what most real estate deals are done as. So, when the distributions go out on the K1 at the end of every year, the fund can take advantage of certain aspects and, stackable programs. It can work in conjunction with EB5 investments into, a lot of EB5 is centered around real estate deals, stuff like that. So, you really can kind of be pretty robust with the usage of how this program is interconnected with other tax programs.
That's something that I hadn't understood. I mean, that's kind of like turbocharging the the tax viability, or just, I mean, because on the Opportunity Zone Fund, again, that's all about attracting investment, but a lot of those other tax programs are about, and I don't want to put a blanket
Yeah, that's a lot of
over all of
rabbit
them.
holes to go down.
Yeah, but I mean, some of them that I'm familiar with are additional funding sources available in
Yeah, like
what what I'm
EB5 is a funding source that could be used in a capital stack on a project, along with Opportunity Zone money.
right. So you can essentially lower your leverage based on all of which in the end makes the property perform that much better. I mean,
Yep.
that's the point. I think if you're going to take something away, that when you add all of those additional programs together, it makes that property perform even at a greater level than
Yeah.
if you were just coming in a standard investors come in with the down payment, you borrow the balance kind of thing.
Mhm.
So on the properties, on the substantial improvement, can you define that? Is there a measure of what substantial improvement means?
So you're going to have a cost basis to improve. So you've got to do that basis plus $1 minus the cost of land for substantial improvement.
So if you bought something for $1 million, and just for round numbers, the
You
dirt
got,
was
if you
worth
bought it for $1 million, the dirt was worth 100. You got
200, or
900,
yeah,
200. You got 800. You got to put 800,000 and
one.
$1 in.
Gotcha,
Yep.
gotcha. All right. So, all right,
And
we
with
walk.
original use, you don't have to meet that threshold at all.
Okay,
There
original
is,
use, because you're coming in with new construction essentially. Then, are you not?
yeah,
Or okay,
yep. 9 out of 10, 8 out of 10 times it'll be new construction on original use.
okay. So we've talked about the benefits of a fund. We've talked about essentially what types of properties qualify and what kind of projects. Um, how Tell me how easy I'm sorry, Easy Do It, right?
Do it. Yeah.
Easy Do It. Where do you guys fit? Are you guys creating the funds? Are
So
you
we offer a turnkey fund development platform where our team sets up the Opportunity Zone Fund, which includes, everything from your entity formation, your financial forecasts on the fund, our legal team take care of the private placement documentation to raise the money, term sheets, sub agreements. Our graphics, video, web marketing team takes care of developing out the website, getting it distributed out, doing the pitch decks, pitch videos. Basically, it is a full turnkey where you're taking saying, hey, I got this project. Help me get this in front of investors the right way as an opportunity fund. You bring it to us day 1, day 30, you're able to connect with investors. We integrate a third-party fund administrator that oversees, investor onboarding, compliance, reporting. So that way, none of that stuff is on the project manager or the fund manager, because they're usually one and the same. So it's designed to be very, very turnkey, very easy. Flat rate. We're not broker dealers, so we're not getting paid on the raise. We're not coming in, on a commission or anything else to that nature. It's just boom, done, and built to spec, ready to go anywhere. So we do that, and then we also have our own directory listing, ozfunds.com. So since we're talking about Opportunity Zone funds, ozfunds.com is our directory listing for Opportunity Zone funds. So we'll list it there, and we've got an education platform as well. We educate people, on the subject of opportunity zones from an advisory standpoint. And then also, that's what we kind of do for our clients. It's a turnkey 30-day in-out.
Got it. So you're taking something from an idea to the execution. I mean, I think a lot of
In its
times
entirety.
the idea is that somebody goes, wow, an opportunity. I mean, the opportunities, and we need not. I mean, that's about the
shortest distance between 2 points is a straight line, right?
Right.
And when you look at what most people do when they start something new, because the reality is all an Opportunity Zone fund is a shell company selling equity, whether it's a partnership or whether it's a stock, doesn't matter, because it's selling equity to you and me, the investor, for our capital gain money. When we invest, we're getting equity, either partnership or stock. It's then funneling that money into an investment. So you got to look at the mechanical basis of what an Opportunity Zone fund is a business raising capital, selling equity. And so when you think through that, then from an execution standpoint, most people zigzag their way through. And all we're saying is, guys, listen, we've done enough of these. We've been responsible from day 1 all the way up to today. Huge market share we've built. We've just have figured out how to build in an assembly line process to where instead of, you're thinking one thing and then, you're already trying to put the cart 5,000 steps in front of the horse. We just keep everything in an assembly line. You order your Corvette, you come out, drive it off the lot. That's our concept. And it's easy do it.
Yeah. I think that's the underlying, takeaway from this is that it is Easy Do It. I mean, it's a great name for your company, because like I said, I've talked with numerous people, but they've been more the sponsor type, and not that they've, you know, dwelled on the back office or all the bits and pieces, but what I'm hearing you say, and I guess let me confirm with you, is that if somebody has an idea, they've got a property in mind and they've got access to capital and they're looking to do a property in an opportunity zone. Okay, but now they need all the functionality, the support, so that they stay compliant. Because
Yep.
you know, if you don't do all the compliance, you've basically, you're bust, or you know, jeopardize everybody in their potential gains. So somebody that define a perfect prospect for you, a typical somebody that's coming to you with a need for your product.
All right. So usually it's number one, when we work with the developers, you know, are they a first time developer, or are they somebody who's a seasoned, you know, commercial developer? They've got a great project. The opportunity zones are not designed, opportunity zone funds and zones are not designed to polish a turd. So if it's a bad deal at the get-go, this is not going to make it any better. Okay. But if this is a good deal, this will make this phenomenal when you look at the tax benefits to the investor. So, you know, somebody who has a good deal, something where they've already got some stuff already figured out on the project, you know, maybe feasibility studies have been done. They've got a good business plan for what they want to achieve, or a good development plan for it. They've got a good, you know, project highlight. Somebody who's coming to the table with at least something that we can kind of take and run with. And we know that there's a lot out there because we get solicited by so many projects looking for money. So we see these things all day long. And I think that's the more bigger thing, I think, is not what the ideal client is. I think it really is understanding, if we could, the economics of the market space for a second. Because when you really kind of think about it, when you're in commercial development and you're looking for money to get any type of project done, you're trying to find either investors or you know, traditional outlets or whatnot. With opportunity zones, there are only about 600 opportunity zone funds out there. That's it. About 600 of them that are real, actually taking money in, doing it. But what's really important that nobody talks about, and this is why the economics of it, I scratch my head sometimes, and this is perfect for your audience, okay? When you look at those 600, first of all, 15% of them are business, meaning that they're focused on making investments as either like a venture capital fund or just into supporting a startup or the growth of a business. So let's exclude 15%. For the real estate purposes, we're now working with 85% of the share space. In that 85%, by design, these are offerings to investors, which means there's a private placement that goes along with it. That private placement is following some sort of reg offering, whether it's an A, B, C, or D offering. All right. Most of these are CD offerings. Some of them are Reg A, but that's rabbit holes. When you look at that, 60% of the 85% market space in real estate, 60% of them are single asset focused funds, meaning that they can't take or invest into any other deal other than the one that they showed you and me as an investor legally. So now you have 40% that are multi-asset. Out of that 40% that are multi-asset, all of them are highlighting anywhere between 1 to already 3 deals that they've got on their plate as an opportunity fund. So even them having excess capital to invest into an opportunity zone project, they don't have right now. The problem is we have an inverted supply-demand yield curve, but the market space doesn't fully recognize it because they're missing the forest from the trees. What we have is we have an exponentially huge amount of capital gain investors, and we have a very small pool of opportunity zone funds. The real estate market, commercial real estate developers, the worst thing that they could be doing right now is trying to solicit an opportunity zone fund, which we see all the time. I can direct any real estate guy to an opportunity zone directory that's got 25,000 projects in these opportunity zones looking for funding right now. You have economic development agencies within municipalities that, other than tax benefits, are themselves struggling on how do we implement working this program with funds, fund managers, and projects getting developed. If you look at what they're doing, they're mainly doing project solicitation as well. They're saying these are the projects that we as a city have to be able to offer within an opportunity zone for an opportunity zone fund. The reality is the opportunity zone funds, far and few between, are looking for extra projects right now. But you've got all this capital that's looking for a spot to go into, and there's not enough. So the best thing that any developer could do right now is, if you've got a great project in an opportunity zone, don't go fishing in a small pond that doesn't have any money in it. meaning the OZ fund market, go fishing in the capital gain market as an OZ fund. Come out and be that 601. So that way you can hit a much, much larger market share. Because if we look at the tidal wave of capital gain investors, right now, because of all the different COVID extensions related to this program, we have investors that go all the way back to October of last year that are still eligible for participation in this program. Every investor has till the end of the year. Stock and real estate. So we have this huge tidal wave. We have more liquid money sitting aside in people's bank accounts than ever in the history of our country. Right now, we've got changes that have been made to the Volcker rule from an SEC standpoint for banks, and also from a CRA guideline standpoint for banks to now get involved with investing in opportunity zone funds as an investor. Being able to, we're there. We're at that spot where a developer could set up an opportunity zone fund, walk into the bank that they usually would get a loan from, and say, hey, let's talk about the bank investing in this as a fund. And the bank get benefits of it. I mean, we're at that point now. But the market, when you look at the economics of the market, we're so inverted that we don't have enough supply. The demand is there. We don't have the supply chain to handle it. I mean, it's like, scratching the tip of Antarctica with a toothpick.
Yeah. No, that's a good problem to have if you're, if you're selling the product everybody needs. That's where you want to be. So that's good. That's good. David, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and one of the things we do is we try and manage risk. And there's a couple of different strategies we typically consider. The first is, can we avoid the risk? If we can't avoid it, we look to see if there's a way we can minimize the risk. And then if we're not able to avoid or minimize, we look to transfer the risk. And that's what an insurance policy is. And I like to ask my guest if they can identify what they consider to be the biggest risk. If you can take a look at your customers and your business and identify what it is that you think would be the biggest risk, and then explain that. For clarity, I'm not looking for an insurance-related answer, but if you're willing, I'd like to ask you, David Silliman, what is the biggest risk?
I see. Okay, the absolute biggest risk to the whole program is going to be fraud. All right. Fraud, because these are private by design to be between you and me as individual investors into a development. All right. They're long-term in nature, which means that we're not thinking about it every single solitary day as an investor. We already know going into whatever we're putting our money into, long-term, 5 years, 6 years, 10 years. Because of how every last one of these, and it's such a brand new market that, there's not a single opportunity fund has a major prior performance track record. So taking money in from an investor, promising them that we're going to do this, we're going to do that, and then closing up or never even filing the right way to begin with, causing, detriment to the investor from a tax standpoint, thinking that here they're deferring and now they've been collecting interest on taxes that are due because the fund never did the right thing. And the people behind the fund made it look so great that, they took the people's money and ran. And when we look back at the history of track record of government programs, I speak truth on this because I built and operated one of the most successful loan modification companies on the East Coast. It was called the Cornerstone Group, had 175 employees, 2 call centers. I built a multi-million-dollar business on the back of a government program once before. Fraud, the proverbial saying of a few bad apples will ruin the entire basket, was absolutely true in that program. We heard horror stories of people that, gave money to companies out in California, told don't make your mortgage payments, and then ended up losing their houses, and the companies closed up shop. That program was very dramatically changed through legislation and strokes of pen from executives, i.e. at the White House. This program has an immense amount of propensity for overwhelming change in an amazing way, opportunistic way in America, an amazing way to make a lot of great money. What it lacks, because of how it's written, there is no set platform yet. There is no set directory yet. There is no set, hey, this is the proper process and what you need to be able to do when you build one of these things. And so that way, all the way down the supply chain, it's transparent and everybody can get into it and know that, okay, no matter what, that doesn't exist yet. Because this market is a brand new financial market that is penetrating both real estate and business. And within that, it has to grow. And it's like a baby right now that's teething. It has the ability to do amazing, and the legislative support behind it is bipartisan. But at the same time, the biggest concern would be fraud. The second biggest concern, I think, that would be to go along with fraud, and kind of briefly touched on it, I think it probably plays into that fraud the biggest way, is right now, as an opportunity fund being private, you've got SEC compliance, you've got, state compliance, blue sky laws, plus whatever your corporate entity, is both, registered and foreign, because most of the time you're going to have two entities at a corporate level with these. A lot of this is still the compliance side. And that would be the second biggest risk. None of them are proven. I can't tell you as an investor, hey, listen, this fund has performed at a 10% interest, rate of return for the last 10 years. Not a one. I can tell you that, hey, my company has done, $50 million in development projects. And so you can trust us. But at the end of the day, as an investor, and that's the risk is at the moment, because there is no centralization on really, what it looks like, from that mass propensity of fraud. And then you couple that with no performance, they're ultra high risk investment vehicles with huge upside potential, but also really high risk up front.
Yeah. Know thy operator, huh? Or know thy sponsor. That's well said. I think that, like you said, even the lack of a track record and then just the time that the investment has to go is there will be a tale to be told. So that's good.
There will be. There definitely will be. And when we build funds at Eazy Do It in our turnkey model, we do coordinate with a lot of broker dealers, RIAs, family offices, a lot of accredited investors that we have gleaned a lot of experience from trying to build an opportunity zone fund. When you don't have prior performance, your next best thing is full transparency. So when we build, we really took the FINRA 1022 checklist that a lot of brokers use when they do underwriting and due diligence and vetting these things. And so from a documentation preparation standpoint, from a third-party integration standpoint, we go above and beyond to set up measures to always protect the investor. So that way the underlying sponsor of the fund, when it's all said and done, they've set up a fund, let's say it raises, $20 million. They get access to that by submitting a release request to themselves, and it gets documented. And then that way there's third-party transparency for investors to always know where the money went, what it went into, and, knowing the value. And I think, we don't have a defined system yet. I'm hoping that, enough of us doing this the right way will help kind of create a proper guide path. And if we can, as professionals in the industry that are, both business and real estate within the opportunities, and when we talk about it, if we understand that, hey, the biggest risk is fraud, and like we briefly just said a minute ago, then if we can stay collective when we talk to our clients, when we know that, hey, this is how things need to be done, we can have a better path to follow and hopefully avoid, drastic changes. Because if the administration is smart, the changes that are to come are only going to incentivize investment into this program even more over the next 6 months. And, the fraud aspect of it, we still won't know for another 2-3 years. And that's a little scary, but I think, if you're cognizantly aware of it, and that's the biggest risk going into it, always thinking that, hey, just transparency, be honest, right? You'll have no problems.
Well, it makes good sense. David, where can the listeners go if they would like to learn more or connect with you?
Sure. They can visit us right online at eazydoit.com, EAZYDOIT.com, Eazy Do It. Also, if they're looking to get more educated, they can connect with us on ozfunds.com. If you're an investor looking for an opportunity fund, we probably have the most robust fund directory available right now at ozfunds.com, along with an education platform.
Great. David, I can't say thanks enough for taking the time to talk. I've enjoyed our talk, learned a lot, and I hope we can do it again soon.
I look forward to it. Thank you.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.